The market does not move to harm you. It does not move to reward you. It simply moves. It is an indifferent ocean of data, price action, and liquidity. Yet, within the mind of the trader, this indifference is often mistaken for an adversary, or worse, a fleeting opportunity that will never return. This is the genesis of FOMO, the fear of missing out. It is not merely a modern acronym. It is a primal, biological response to perceived scarcity. In the context of the financial markets, it is the single most destructive force a trader will encounter. It is the silent thief that steals capital, erodes discipline, and dismantles years of progress in a single, impulsive click. To the undisciplined, a green candle is a call to action. To the disciplined, it is simply a data point. Today, we will not discuss get-rich-quick schemes or secret indicators. We will instead dismantle the internal architecture of the impulse trade. We will explore why your brain is hardwired to chase and how you can cultivate the psychological armor required to stand still while the world rushes past. At its core, an impulse trade is a failure of the prefrontal cortex to override the limbic system. When you see price moving rapidly away from your entry point without you, your brain perceives this as a loss of resources. In the ancestral environment, missing a hunt meant hunger. In the modern market, missing a move triggers that same ancient survival mechanism. The FOMO response is characterized by three distinct psychological phases. First is the perception of scarcity. You believe this specific move is unique. You tell yourself that if you don't enter now, you will never see a setup like this again. This is a fallacy. The market is infinite, and opportunities are always on the horizon. Second is the emotional hijack. Physiological changes occur. Your heart rate increases. Your vision narrows, literally and figuratively. You stop looking at your checklist and start looking at the profit you could have banked. Third is the rationalization. This is the most dangerous phase. Your mind begins to manufacture reasons to break your rules. I know where price is drawing. I'll just take a smaller position, you say. All of a sudden, you are no longer trading your plan. You are negotiating with your own greed. When you feel the urge to chase, you are not seeing the market. You are seeing a projection of your own anxiety. The impulse trader suffers from a lack of perspective. They view every trade as a verdict on their worth or their intelligence. If the trade goes without them, they feel they have missed out. This is the lottery mindset. It stems from the belief that wealth is found in a single, massive move. However, professional trading is not about the singular. It is about the aggregate. It is a game of probabilities played out over hundreds and thousands of iterations. Consider the nature of a high-probability setup. By definition, it requires specific conditions. It could be accumulation, manipulation, distribution, fair value gaps, order blocks, or support and resistance. When you enter an impulse trade because price is simply moving, you have discarded every one of those conditions. You are no longer a trader. You've activated the gambler inside. If the market makes a large move without hitting your entry criteria, that move did not belong to you. It was never yours to have. To feel FOMO over a move that wasn't in your plan is as irrational as being angry that you didn't win a lottery for which you never bought a ticket. The professional trader realizes that he cannot open a position if it's not within the specific strategy. The cost of chasing. The damage of an impulse trade is rarely limited to the financial loss. The capital can be recovered. The psychological integrity is much harder to repair. Every time you give in to FOMO, you are reinforcing a neural pathway. You are teaching your brain that your rules are suggestions and that your emotions are the true captains of the ship. This creates a discipline debt that leads to the revenge cycle. Often, an impulsive entry leads to a win or a loss. Because the entry was emotional, the exit becomes emotional. If the trade is a loss, you will likely revenge trade to get back what the market took, leading to a spiral of drawdown. After the market closes, the damage you've done sets in. You look at all the trades you took that day and realize that you broke your rules again. You lose trust in yourself and your system because you can't control your emotions. Impulse trades almost always have poor risk-to-reward ratios. Because you entered late, your stop loss must be wider or placed in a technically invalid area. You are risking $2 to make $1. This is the mathematical path to ruin. True authority in trading comes from the ability to say no. No to the mediocre setup. No to the parabolic move that lacks a pullback. No to the desire to chase because of FOMO. How do we solve this? How do we move from the impulsive to the intentional? It's very simple. You need to shift from an outcome-oriented thinker to a process-oriented thinker. Step 1. The checklist. Never enter a trade based on just a feeling. You must have a written set of criteria. If one criteria is missing, there is no entry. Your job is not to catch moves. Your job is to execute your strategy. Spend time forward testing a strategic plan based on your personality. Everyone is different. Some people like short in and out moves, and some like longer forming expansions. To each their own. Step 2. The 15-minute rule. When you feel the physical sensation of FOMO, you know when it comes. When you receive that message from your brain, force yourself to step away from the screen for 15 minutes. Breathe. Remind yourself, I need to control this urge. Step away for a bit and regain your senses. Step 3. Redefine the miss. Change your internal dialogue when it comes to missing moves. A move that happens without your signal is not a missed opportunity. It is a move that happened in another trader's strategy, and it was their turn to execute. For you, it's just a successfully avoided non-setup. Your success is measured by your adherence to the plan and not taking random setups outside the rules. A non-trade is also an action, and it is one of the best actions you can take. You lose no money when you hold back. Step 4. Embrace the abundance of opportunity. The market will be here tomorrow. It will be here next year. There will be another trend, another breakout, another reversal. It's always moving, and there are setups happening every day and night. The only thing that can prevent you from participating in those future moves is the destruction of your account today. To treat a single missed trade as a catastrophe is to misunderstand the infinite nature of the market. It is like standing on the shore of an ocean and fearing that the next wave will be the last one ever to break. In reality, the market is a machine that will generate thousands of setups down the road. If not this hour, then the next. If not in this session, then another. Your capital is your oxygen. Without it, you cannot breathe in this environment. By refusing to chase, you are not losing a profit. You are preserving the very tool that allows you to participate in the thousands of opportunities yet to come. The professional trader does not rush because they know that the market's bounty is inexhaustible. But their own capital is not. The professional understands that the greatest victory is not the 10-hour trade, but the moment they watched a massive move happen, felt the pull of FOMO, and chose to do nothing. That is where the real money is made. In the trades you don't take. The urge to chase will never entirely disappear. Biology is not something you fix. It is something you manage. The difference between the professional and the beginner is not the absence of the feeling. It is the refusal to let that feeling take control of the ship. True mastery in this craft is not found in the perfect entry. It is found in the quiet moments of restraint. It is found in the afternoon where you watched the screen for 6 hours, saw nothing that met your criteria, and closed your laptop with your capital and your dignity intact. Every time you choose discipline over impulse, you are not just saving money. You are building a version of yourself that is immune to the market's manipulation. You are transitioning from a victim of price action to an architect of probability. As you observe the next trading session, do not pray for a volatile market or a big win. Pray instead for the clarity to see the market with a logical mind and to control greed. Remind yourself, the market is never ending. There will always be another setup coming. If you miss a drop today, the river will still be flowing tomorrow. Your only responsibility is to stay on the bank until your net is ready. In the end, trading is a mirror. It reflects back who you really are. Cultivate a mind that is like a rock against which the waves of the market continually break. It does not move for the waves, nor does it fear them. It simply remains. Trade with clarity. Trade with discipline.